All right, today we're going to tackle something that, I'll admit, sounds pretty complicated. We're decoding a specialized investment fund, the QSIF Long Short Fund. Now, that first part, QSIF, that's just the brand name. But that long short part, that's where it gets interesting. That tells us everything about its unique strategy. So let's figure out what it is and how it actually works.
You know when you get a financial document and it just looks like a wall of text? All these dense tables and jargon? It's so easy to just set it aside and forget about it. But today, we're going to pull out the most important bits from this exact kind of document and make it all crystal clear. I promise.
So let's start at the beginning. The fund's full name is the QSIF Active Asset Allocator Long Short Fund. Whoa, that's a mouthful, right? But believe it or not, that name tells us a lot. First things first, what is this fund even trying to do with your money? Okay, so according to the official document, this is the core mission. Let's translate that. In simple terms, it's trying to do two things over the long haul. One, grow the value of your original investment. That's the capital appreciation part. And two, maybe generate a little income for you along the way. Now for the really interesting part of the name, long short. This isn't just some random label. It's the entire engine driving this investment strategy. It's an approach that tries to make money in more than just one way, which can be really handy, especially when the markets get a little wild. So what on earth does long short even mean? It kind of sounds like a contradiction, doesn't it? But it's actually a pretty clever strategy that's all about making two different kinds of bets at the very same time. Let's break that down. The whole strategy really just boils down to making two different bets at once. Think of it like you're betting on a sports game. A long position is your normal bet. You're betting on a team to win. You buy an asset, say a stock, hoping its price goes up. Easy enough. A short position is the total opposite. It's like betting that team's gonna lose. You're making a bet that an asset's price is gonna go down. So why do both? Well, by playing both sides, the fund tries to make money even if the market is flat or falling. It's a way to potentially reduce the overall risk compared to a fund that only bets on things going up. Okay, so how can you even bet on something going down? Well, the main tools are these financial contracts called derivatives, things like stock futures. Now, you don't need to be an expert here, but the key thing to know is that these are the instruments that let fund managers take those short positions. They make it possible to borrow an asset, sell it, and plan to buy it back cheaper later. That's the magic behind the short bet. All right, so we get the goal and we get the strategy. But what's actually inside the fund? What kinds of things are they going long and short on? Let's pop the hood and take a look at the portfolio to see how it all fits together. This chart shows us the maximum amount the fund can invest in different areas. And what it tells us is that the fund manager has a ton of flexibility. They can lean into whichever asset class they think has the most potential, whether that's for a long bet or a short bet, all based on what they think the market is going to do. And when you really dig in, you see just how wide the investment universe is for this fund. We're talking about pretty much everything: stocks, bonds, commodities, real estate, even securities for markets overseas. This huge multi-asset toolbox is what gives the managers so many options for putting that long-short strategy into action. You know, anytime you have a sophisticated strategy like this, there's always going to be some important fine print. So now, let's look at two of the most critical pieces of the puzzle for any investor: the risks involved, and of course, what it costs to invest. This is always one of the first questions you should ask. I mean, a strategy that's trying to profit from the market going both up and down sounds pretty complex. So what does the official regulator have to say about its risk level? Well, the official riskometer gives us a really clear answer. This fund is rated as a level 5, which puts it squarely in the high risk category. So what does that really mean? It means anyone investing should be prepared for some pretty significant ups and downs in the value of their investment. These complex strategies can definitely come with higher volatility. The other huge question is always about the fees. How much does it actually cost to have your money managed with this kind of active strategy? There are two main costs you really need to be aware of. First up is the annual fee, which is often called the total expense ratio. This fund can charge up to 2% of your investment every single year. That fee covers all the management and operational costs, and it comes directly out of the fund's assets. The second cost is a little different. It's called an exit load. Basically, you can think of it as a fee for pulling your money out too quickly. It's really there to encourage people to invest for the long term and not just jump in and out. For this particular fund, if you decide to sell your investment within the first 15 days of buying it, you'll get charged a 1% fee on the value. But after those 15 days are up, there's no exit fee at all.
Okay, wow. We've covered the goal, the strategy, what's inside it, the risks, and the costs. Let's pull this all together into a final summary of what you really need to remember from all this.
So, let's just recap the most crucial points. This is a fund that's aiming for long-term growth. It uses that complex strategy of betting on things going both up and down. It has a ton of flexibility to invest across all sorts of asset classes. But, and this is a big one, it comes with an official high-risk rating. And finally, you've got those key costs, up to 2% a year, plus that 1% exit fee if you sell in the first 15 days. And that really brings us to our final thought. Now that you understand how a long-short fund actually works, the big question becomes a personal one. Is a strategy that actively tries to navigate and profit from both the ups and the downs of the market, could something like that have a place in your own long-term financial plan?